Hi, my name is Neneng Djuaeriah from Swiss German University, together with Bella Joy Winarta, my student who is now working for PwC Indonesia, to present our research paper. The title is The Effect of Capital Structure and Agency Cost Towards Profitability, a case study on Indonesian firm. So introductions, the effective financial management can be obtained from better operational performance. This better better operational performance is used to make a capital structure decision. Of course, the formulation of between debt and equity financing is very important in a capital structure decision making process, because financial distress and bankruptcy can occur because of the false capital structure decisions. A wise capital structure decision is essential for a company to achieve the objective of the organization according to ABOR 2005. Agency cost is used to solve the conflict between management and the shareholders. It is considered as the internal cost which has to be paid by the shareholders to agents representing management. Therefore, the management could act according to the benefit of shareholders' interests. The research purpose is to seek whether the long-term and short-term liabilities, equity ratio, and agency costs affect profitability. The control variable used in this research are size and sales growth. So the next is the literature review. The structure of capital consists of mixed equity and debt financing, according to Brilli et al. 2009. Debt financing gives some benefit to the firm or other than the tax shields. Firstly, the debt used by firm for advertisement purposes. As an increase in firm leverage will increase the firm value, since level of leverage would enhance the value of the market realization, according to Ross 1977. Secondly, equity-related agency cost issue can be decreased by debt. The pre-cash flow related agency issue are mentioned as investment issue according to Jensen 1986. Thirdly, management of agent expenditure is reduced by debt as a shareholder are represented by managers. Agency cost is used to solve conflict between management and the shareholders. According to Young 2016, the core problem of Lehman Brothers case is the asymmetrical information between the principal and agents. The agent did not act at the best profit of the principal and caused the agency issues. The agency cost, according to Jensen Mackling to 1976 and Meyer 1977, and tax deductibility of interest and bankruptcy costs, according to Kim 1978, are the main benefit of debt financing. From the researches conducted by Gill et al. 2011, Adai et al. 2013, Muchunga 2013, Mawangi et al. 2014, illustrating that short-term debt has a positive significant impact on profitability. This is because it has lower cost than the long-term debt financing. According to Poyeke et al. 2016, it is stated that the firm value will increase if the company uses equity financing. This trend is confirmed by the result of Cratchit and Oliviola 2014 and Salawu 2009. Their results suggest that equity financing has a positive effect on firm value positively. The firm size had a positive correlation with firm profitability in financial service sector, as the study conducted by Amato and Burson 2007. This means that a smaller firm will tend to have lower value than larger firm. The researches are conducted by Olubukunola et al. 2011, Whittington 1980, Malik and Iqbal 2012, Akinlo 2012, are illustrated that positive significant correlation of sales growth and on return income resulted from their study. This due to a higher sales growth would create higher firm shareholder value and its profitability, as done by Des and Robinson 1984 and Markman and Gardner 2002. These are the conceptual framework we use. The following graphic is our conceptual framework, where the dependent variable consists of profitability, which are represented by return on asset and return on equity. And the independent variable consists of long-term debt LD, short-term debt SD, EQ equity ratio, and AC is agency cost, where the control variable consists of size and growth. And these are the hypotheses, consists of 6 hypotheses, one each for ROA and ROE. The variable measurement we use is ROA, ROE, long-term debt, SD, AC, comes from total operating expenses divided by total annual sales, equity ratio, total equity divided by total asset, whereas the firm size is coming from log total annual sales. Sales growth is the total sales current total sales minus previous total sales divided by previous total sales. Population and samples. The population in this research is companies from the LQ45 registered in Indonesian Stock Exchange or IDX. The period of sampling is from 2013 to 2017. The criteria used to select the sample are as follows. There are 580 companies listed in IDX and constantly publish its financial statement in IDX from 2013 to 2017. There are 29 companies are those constantly listed in IDX LQ45, including 5 banks and financial institutions. The 24 chosen companies exclude the bank and financial institutions. The research model, there are 2 research models for ROA and for ROE. ROA equals to alpha plus beta 1 times LD plus beta 2 times SD, beta 3 times AQ plus beta 4 times AC plus beta 5 times size plus beta 6 times growth plus error, similar to ROA, where SD is short-term debt, LD is long-term debt, AQ is equity ratio, AC agency cost, size, firm size, growth, sales, ROA equals to return on assets and return on equity. The research question used in our research: do long-term debt, short-term debt, equity ratio, agency cost, size, and sales growth have effect on profitability of Indonesian firms? And the result from descriptive statistic, it is concluded that 52% of Indonesian firms using equity financing, and the rest of 38 only use 38% debt financing. 38% of those companies are using debt financings. And from the standard deviations, mean and maximum and minimum, the highest is for growth and sales, firm size and growth or sales growth. And from the classical assumption result, it is concluded that the data has normally distributed, and then the data also following the multicollinearity, but it doesn't. This data does not pass the heteroscedasticity and autocorrelations. Therefore, this data is only valid for this research. Result from the regression result, or ROA equals to 0.192 minus 0.040 LD plus 0.277 SD plus 0.070 AQ plus 0.035 AC minus 0.020 size plus 0.003 growth, and ROE equals to minus 2.58 minus 0.291 LD minus 0.0319 SD minus 0.022 AQ plus 0.059 AC plus 0.001 size minus 0.01 growth. So it means every 1% increase in ROA will decrease the long term. Every decrease 0.04% LD will increase 1% ROA. So from the previous table showing that the long-term debt has a negative significant effect on return on asset at 1% level, confident level, and a significant positive correlation on return on equity at 5% confident level. while the short-term debt has positive significant influence on both return on asset and return on equity at 1% confidence level. The equity ratio and agency cost have positive effect on return on asset and return on equity but are not significant. The agency costs have positive insignificant effect on return on asset and return on equity. The firm size has a negative insignificant effect on return on asset while a positive insignificant on return on equity. Furthermore, the sales growth has positive effect on return on asset and a negative insignificant influence on return on equity, but both are insignificant effect. So the long-term debt has a negative influence on ROA at 1% confidence level and positive influence on ROE at insignificant level 5% means that the increase in the long-term debt will tend to decrease ROA of the firm. This is following the research conducted by Adai et al. 2013 and Muchunga 2013, Tipo and Savir 2015. Therefore, H1A is accepted and H1B is rejected. The short-term debt had a positive significant influence on ROA and ROE at 1% confidence level. This indicates that the increment of short-term debt would increase profitability. This is in line with Jill et al. 2011, Adai et al. 2013, Mawangi et al. 2014. Therefore, H2A and 2B are accepted. Equity ratio has a significant positive on ROA and ROE. It is showing that an increase of equity financing will increase by profitability, firm profitability. This is following the research conducted by Antwi, Mills, and Zhao 2012. Therefore, H3A and H3B are rejected. Agency costs had an insignificant positive impact on ROA and ROE. The higher agency costs may tend to higher firm's profitability. The same result experienced by Wang 2010, Crecet and Olaivola 2014, and Salawu 2009. This result is in line with Djuaeriah, Burhanuddin, Chong, and William 2016, Meyi 2013, and Ang et al. 2000. Therefore, H4A and 4B are rejected. The firm size has a negative insignificant correspond on return on asset. The higher the log of annual sales lead to lower return on assets. The same result is supported by Kartikasari and Merianti 2016, Ang and Pak 2011. Therefore, H5A and 5B are rejected. The sales growth had a positive insignificant influence for return on asset and return on equity. Des and Robinson 1984, sales growth would lead to increased shareholder value creation and in turn company's profitability. This is supported by research conducted by Markman and Gardner 2002 and Gwansner 2005. Therefore, H6A and H6B are rejected. In conclusion, can be concluded that LQ45 listed in IDX use 52% equity financing, then debt financing of 38%. The long-term debt had a negative insignificant effect on return on asset at 1% confidence level and significant positive correlation on return on equity at 5% confidence level. Therefore, H1A is accepted and H1B is rejected. While the short-term debt had a positive insignificant influence on both return on asset and return on equity at 1% confidence level, then H1, 2A and 2B are accepted. The equity ratio and agency costs have positive effect on return on asset and return on equity, but insignificant. So H3A and 3B are rejected. Then H4A and 4B are rejected as well. The firm size has a negative insignificant effect on return on asset while a positive insignificant effect on return on equity. Then H5A and 5B are rejected. Furthermore, the sales growth has insignificant positive effect on return on asset and negative insignificant influence on return on equity. Therefore, H6A and 6B are rejected. The recommendation. Based on the result above, there are some suggestions for the future researchers. First of all, the increased sample size could be increased as it is only limited to LQ45 companies. So it will provide more sample size to get better accuracy data than currently used. Secondly, The sector base can also be done to identify which sector will use more debt financing than equity financing. Furthermore, the future researchers can compare between subsectors of each industry or with other countries. Thirdly, the future researchers may use also panel data of unbalanced panel data. This panel data should examine the company having insufficient data. It could expand sample size and prove better accuracy result. Lastly, it may possible to add financial institution as part of sample size, as they are excluded in this research. So these are the references we are using, and thanks for listening our presentation.